Okay, good morning, everyone. Thank you for joining our webinar this morning. I'm Ron Shapiro, Assistant Professor of Professional Practice in the Finance and Economics Department at Rutgers Business School. Before we begin, a few housekeeping issues. The chat box has been disabled. We encourage questions from the audience. Please submit your questions through the Q&A panel. Identify the speaker who you would like the question to be answered. If it's more than one person, please feel free to mention both panelists' name as well. There is a link to the slide deck in your chat box that you can refer to for more detailed information on the panelists and their email addresses. In addition, we will have a networking session at the end of our program. The link to that session will also be sent to you, and you can find that in your chat box as well. The webinar will be recorded. I want to say a word about our production people. I'd like to thank Financial Poise Production for handling most of the production, promotion, and logistics for this webinar. Please check out Financial Poise's website. They provide continuing education for the legal, financial, real estate, and private equity professionals. Financial Poise has a division called Daily DAC. If you are involved in distressed assets, check out Daily DAC's website as well. And toward the end of the slide deck, there are several slides that will give you more information about both units. You can sign up for both of their free e-newsletters. And with that, I would like to move forward by talking about what the webinar is all about. So the current economic crisis is creating unprecedented economic difficulties for property owners and lenders. Firms and owners are filing bankruptcy, defaulting on loans, auctioning off assets, and closing up operations. Asset values are declining, workout negotiations have begun, lender defaults are occurring, and foreclosures have been filed. Where do we go from here? We have 6 excellent panelists who will speak to the various capital, legal, financial, and operational issues owners and lenders are currently experiencing. And let's go to the full slide with all the panelists. What strategic advice and recommendations do they suggest? I do want to take a moment to thank each of our panelists, each of our sponsors for participating and providing their expertise to today's program. And with that, I want to introduce each of our speakers, and I'm going to provide just a few sentences about each because their detailed bios are in the slide decks that you each have received. I'm going to introduce them in the same order in which they will provide their presentations to you. James Shevlin is President and Chief Operating Officer of CW Financial Services, LLC, a division of CW Capital. James has over 25 years of expertise originating, underwriting, evaluating, auditing, managing, and disposing of more than $100 billion of commercial real estate properties throughout the United States. Matthew Schiller is a partner at the law firm of Murphy, Schiller, and Wilkes. The law firm is located in Newark, New Jersey. Matthew's expertise is involved in the acquisition, disposition, leasing, and operation of office, retail, industrial, and multifamily properties. And Matthew has a significant focus on properties located in various opportunity zones across the United States. Steve Schultz is an executive managing director in the Newmark Knight Franks Capital Group. Over the past 2 decades, Steve has negotiated and developed deals totaling more than 8 million square feet and represented by over 15 billion in market value. Steve is considered one of the more active and accomplished real estate professionals operating in the New York, New Jersey, Pennsylvania, and Connecticut markets. Joshua Olson is founder and managing partner of Auction Advisors. Joshua has extensive experience advising fiduciaries, corporations, financial institutions, and individuals in the disposition of real estate and real estate-related assets throughout the United States. He has helped build Auction Advisors' strong regional and national presence by designing and implementing auction campaigns that are efficiently run and consistently delivering superior valuations. William F. Looney III is president of U.S. loan sales at DebtX. Under Bill's sales leadership, DebtX has grown from a startup to the nation's largest loan sales company. Bill is a lawyer by background, and he also acts as DebtX's Chief Operating Officer. Finally, we have Michael Bell. Michael is president of Bell Aldo, a real estate due diligence consultancy firm that focuses on environmental due diligence and environmental risk management for banks, private equity firms, and insurance carriers. Michael spends a lot of his time coordinating environmental reviews during the loan acquisition due diligence process. He performs annual loan reviews and completes investigations before foreclosure. He's also, I want to add, a certified professional geologist. So that is our panel. And with that, we will start the individual speaker presentations, starting off with James.
Thanks, Ron. Thanks for having me. And, you know, we were talking about having this panel, I believe, in December 2019. And oh boy, what a different discussion we're going to have today than we would have back in December. So just to give everyone some perspective, on January 1, our special servicing book was about $1 billion in size. Today, we're approaching $6 billion. So how did we get there? Well, COVID came along in March. We received 578 relief requests totaling $17.7 billion. Majority of that came from property owners in the hospitality and retail industry, as you can imagine. You know, when this crisis hit in March, the first assets to be affected was hospitality. Hospitality, you know, is a day-by-day business. You have no idea who's going to come in the door the next day, and you know, immediate liquidity issues there. And retail, which was struggling even prior to COVID, really took a hit. So, you know, with those relief requests, we granted forbearance to a good portion of borrowers and handled that as almost like a consent, where they were able to tap into their replacement reserves, or we gave them a little bit of time to pay back whatever deferral they were requesting. So where are we at today? You know, what trends are we seeing today? So number one, on forbearances, round one forbearances have come to an end. Some have performed and have paid back what they said they would do. But there's also a good portion that need additional relief. And we're handling that, you know, a variety of ways. One, we may grant them additional time to pay back money. Two, it may be a discussion about handing over the keys. Or three, it's a combination where we're asking the borrowers to step up and contribute equity to the deal. And that's, you know, probably a little harder stance we're taking with the round two forbearances. You know, the trends we're seeing there, hospitality is still going in the wrong direction. You know, travel is not coming back. We don't see it coming back until probably, you know, mid next year at best, and at what levels we don't know. So there's more discussions around hospitality of deals coming into special servicing and either a major mod or potentially hand the keys over. One interesting trend we're seeing on retail is more deals being brought current than we anticipated. And I think that's a function of as more things open up, more businesses open up, they're able to pay their rent. But the longer this goes on, who knows? Um, you know, Property values are another trend that we need to keep an eye on. In the hospitality industry, we looked at our portfolio and looked at appraisals that we've ordered during COVID, and hotels are down 23.5%. Retail down 20%, and mixed use down 37%. So very, very concerning where those trends are going. Multifamily and office, there hasn't been many deals that have come into special servicing to order an appraisal on, but those are the two big unknown asset classes right now that we're just not sure where they're going to go. And what's going to be the new normal in office. I think we're anticipating there's going to be lower occupancies as businesses try to evaluate what their needs are going to be. And I think we will see a lower average rent going forward. Multifamily, the one thing the agencies did was started the whole forbearance idea with 90 days of relief. A majority of the properties have performed well. We haven't seen many defaults, and we have $100-something billion agency book, and we have 5 deals in special servicing. It's just unbelievable. However, with the eviction moratoriums going on right now, the longer that goes on, it's really going to hit landlords, and there's definitely going to be liquidity issues. And I think that's really where we're at overall today is, if you look at the crisis, we're definitely in the liquidity phase problem. The longer this goes on, we move into more valuation decline and, more back looking at kind of 2010, 11, I think that's where this will revert to. Opportunity, there's plenty of money out there that have been raised to do a variety of things. The one positive thing we're seeing, we have an online auction platform called Real Insight Marketplace, and there's been tremendous growth during COVID. Our average bidders have increased almost 100% on deals from 11 to 19 on an average deal. Our pricing, we're getting 154% of reserve, and we're trading about 82%, which is kind of industry leading out there. So, I think from a buyer seller perspective in the distressed world, it's time will tell. But if you're a buyer, there's definitely opportunities out there. As a special servicer, we will need to move some of this distress notes. And I think there'll be a good opportunity for you. REO wise, it'll probably take some time to get through the foreclosure process. It's been difficult with local jurisdictions, but that's only a matter of time before we get to that point.
Okay, Matthew.
Sure. Thank you so much. So again, my name is Matt Schiller. I'm a partner at the law firm Murphy, Schiller and Wilkes up in Newark, New Jersey. By way of quick background, I am a commercial real estate transactional attorney by trade. So I run my firm's leasing practice group as well as our opportunity zone and distressed group. I also handle a significant volume of real estate acquisition and disposition work. 2020 has been a very interesting year on the real estate side, and it's impacted all aspects of the industry in different ways. And we've kind of been seeing this progress throughout the course of the year. It started off obviously with governmental moratoriums on evictions, the use of retail property or the lack thereof of the use of retail property, the significant diminished use of office properties throughout the region in the country, as well as the plummeting usage and the cratering of usage of hospitality uses. So at the beginning of the year, we were focusing primarily on helping our clients understand exactly how to protect their assets and how to sustain their assets, and dealing with tenancies that may be asking for abatements or rent concessions while they're either not actively using the space or dealing with, literally non-existent business uses at that point in time as they're trying to figure out their costs. We also spent a significant amount of time dealing with PPP loan issues and other loan issues, helping clients survive and weather the storm, getting them basically through this summer. And now we're dealing with, a lot of wait and see. The truth of the matter is, at least in the hospitality side, we're really still seeing, hotels still have real significant problems. The other problem area, retail obviously is retail. The other big problem, and the biggest problem that I'm seeing for a lot of my clients, is on the multifamily side. And the reality is almost, the bulk of the states throughout the country, as well as through federal legislation, there are moratoriums put in place on evictions and residential foreclosures. And as a result of that, while landlords in New Jersey and other states may have had the ability to go and either commence actions, they haven't been allowed to actually evict tenants. And even though tenants were supposed to be paying rent, many haven't. And you haven't seen any real legislation put forth to give landlords any sort of relief from paying mortgage payments or paying property taxes or otherwise maintaining the property. And as a result, you have a real hodgepodge of problems where you have, especially in the multifamily side, a lot of underperforming or non-performing assets and landlords that really don't have the ability to be able to go and actually take actions necessary to go and protect themselves and protect their assets and find new tenants or otherwise. And, as of now, most of these moratoriums are still in place and are getting extended in various levels. And so figuring out on a distress side, which assets are going to be able to survive and which assets aren't is very complicated. And further complicating that was the 2019 rent stabilization and rent control ordinances and regulations and statutes that were being passed most predominantly in New York City, but elsewhere as well, which really, really significantly hampered valuations and values of buildings and the ability of landlords to go and invest in their assets. So what am I seeing right now? Right now, I have seen a lot of activity on the legal end, primarily on the mezz loan side. And and that's where you're going to see your first action. I've actually done a number of UCC foreclosures and or assignment in lieu transactions already. Although there, especially in New York, there is a decent amount of case law out there already theoretically impacting mezz lenders' ability to go and foreclose using commercially reasonable means. What does that mean in the era of COVID? We don't really know. It's really done on a case-by-case basis. But you are seeing an awful lot of activity on the mezz side, either on the foreclosure side or mezz notes being put up for sale. And what I would say is, as all of these assets are coming into heightened scrutiny, I think that you still see more questions than answers. It's really important to do your due diligence and try and figure out where these assets are and whether they're salvageable or not, and whether or not you have the capital to be able to do so. On the mezz lender side, I'm seeing a lot of protective advance activity where senior loans are going into special servicing and otherwise, where mezz lenders are having to protect their assets and protect their collateral. That's what I'm seeing right now. And if you are seeing mezz debt put on the market, in particular on the multifamily side, like I said, you really have to understand the asset and pay attention to how long these properties have been struggling and what type of rent control and rent stabilization regulations may have been put in effect over the past year and a half, because that, on top of COVID, is really impacting value and the ability for these assets to perform going forward. So I look forward to continuing this conversation and answering any questions anybody has, but we're really, I think, at the tip of the iceberg here, and we've got a long ways to go. It's not 2008. I think that there's an awful lot of liquidity out there looking for distressed deals. And as a result, I don't think it's going to be the complete bottom barrel basement shopping. I think that there's going to be an awful lot of players out there looking for deals and opportunities. But I do think that 2021, there's going to be an awful lot of activity trying to figure out exactly how we get out of this mess. And the end result of COVID, I think there are still more questions and answers in terms of how it's ultimately going to go and impact everything.
Thank you, Matthew. Let's move over to Steve.
Good morning, everybody. I'm Steven Schultz. I am part of the National Loan Sale Advisory Group for Newmark. We have a team of 11. We cover the whole country. We have, since COVID hit, we turned our business more into an advisory role than a transactional role. Obviously, values have been affected through the COVID pandemic. We are in a more of a wait and see process. Valuation has deteriorated. And we're really trying to help our clients, advise them on valuation and what the market's going to bring. We typically, we sell non-performing loans, performing loans, sub-performing loans. And what has been big so far is a UCC foreclosure, to Matt's point. We're pretty busy with that. We have sold some mezz notes out in the market. It's really going to be interesting to see. We don't even think it's the first inning of what's going to happen in the distressed world. So we're just standing by right now, helping our clients do valuations. We probably have done about $3 billion of BOVs for our lending institutions and servicers. So we're really just watching the market and seeing how we can, advise our banking institutions and lenders through this. The transactional, we have probably sold about 300 million of loans so far since March, but we definitely think there's more to come. I'm going to be short here. I would like to see the questions that are going to be asked, but our advisory group and our Newmark advisory group is ready to get busy in this next wave of the market.
Thank you, Steve. Let's move over to Josh.
Good morning, everyone. Thank you for participating. As indicated, my name is Joshua Olshan. I'm with Auction Advisors. We're based in New York. We do really stuff New York, New Jersey, Connecticut, PA, and the rest of the country. So we are auctioneers, focused more, it seemed like Steve mentioned a lot of loans have really been a lot of action going on in the loan area this year, but we are more focused on the disposition of real assets. We do mostly real estate, but we also have this year been quite busy with business liquidations and asset sales as well, which is part of we're a full service firm. So I'm going to want to just share some slides. I've been seeing, what we've been experiencing hasn't been too different than what has been discussed, but I'm going to just share my screen, and I want to share some slides and some statistics. So first, let's go to the first slide. I want to just show, and this kind of echoes a little bit about what James was saying, but if you see it, the far right shows the distressed property inflows. This really measures either properties that have been identified as distressed properties by Real Capital Analytics, one of the foremost firms in this area. So either something that has been, moved over to special servicing or has exhibited, bankruptcy or some other flag that went up to indicate a distressed property. So we see that it's not just the majority of the properties so far that have been moved over to distress have been from hotel or hospitality and retail, but it's actually 92% just in the second quarter alone. If you look at, the numbers are staggering. If you look, this chart shows back in the, in the height of the financial crisis, we weren't, really even at the level that we hit in the second quarter of 2020. And note, this is a trend. You could imagine what the next quarter is going to look like. But so far, the two areas that have been hit, as can be seen. Now, I note that both these, as this is touched also earlier, retail has been experiencing issues for many years. Retail was already at the brink before this crisis began. The number of square feet per capita in the United States is, I think, like quadruple what it is in Europe. And people, trends, online trends, et cetera, have been, so retail's already been having issues. Hotel was doing a little bit better last year, wasn't doing that great. So it's not too surprising that, in the first round, first wave of defaults and issues have been coming from these two sectors. The question as also touched on, is you see the office splitting up. I'm going to talk about that in a minute, but the office is a big question mark. And that's really a second round because you have the tenants who are having issues and that flows through. And there's been a lot of forbearance so far and, in the office area as everywhere. So that really hasn't, hit as much. But so let me just take you to the next slide just to show you, mention transaction volume has gone down considerably. The bottom row of charts show per property type the transaction volume this year, and of course across property types this has been volume is way down, retail down. I mean, just really across the board. So this is an interesting a thought, and this is very interesting in terms of where we see things going forward. I think right now everything has been people have been in lockdown, transactions have been in lockdown. There's been almost really I think the number in July transaction volume was down 69% from 2019. Overall this year I think it's like down 40%. So what's happening? Everybody's frozen. Doesn't mean there aren't buyers in the marketplace, though. Everybody reads, a lot of dry powder has been accumulated. Private equity money is there on the sidelines. I think in general, ready to pounce. As an auctioneer, we've been getting calls, I'd say in the last 6 months since this pandemic began, from people we haven't heard, in 10 years. In addition to all our regular clients and people looking for opportunities, looking to invest, the number of, new acquisition people looking for us to make sure they're on our mailing list and looking for deals, auction deals, pre-auction deals, bankruptcy. So there's, anecdotally and I think statistically, there's tremendous, money on the sidelines ready to pounce. So this transaction, decline in transaction volume is really more an indication of where things are at in the cycle. And that right now, people are still trying to deal with their problems, still trying to figure out what the next move is. They're not ready to sell. When they are ready to sell, I expect there's going to be a lot of buyers out there, if the price is right, of course. And that really brings me to the next. I will also say before we move on from volume, Steve mentioned he's been quite busy in the advisory for loans. Total trading volume for CMBS, I think this year is up about 25% against last year. So there is a lot of activity in terms of the on the sidelines. There have been a couple of notable kind of loan to own conversions. Starwood lost I think a retail portfolio early this year. So there's been some interesting activity, just further indicating that there is money and people looking to do things on the side. But the sellers are not quite there yet. The banks are not ready to sort of allow things to go in that direction yet. But based upon where these charts seem to indicate, looks like that's coming. So in terms of pricing, of course, that's always people's question, where are we at in terms of numbers. So you see here that this year, all property still year to year is still pricing is up 1.6%, which is, I guess, somewhat surprising. Prices have actually been, there've been a lot of deals at more distressed type pricing. Retail obviously down much more, industrial actually being up. That number, although it's if you look at the industrial up 7.4%, that's up, but not as much as it was up kind of last year. So even industrial hasn't really peaked up. A lot of the issue with the pricing, I think, is that there's been a lot of capital available. Everybody, you know, one of the things that so far has marked this crisis as opposed to the great financial crisis, there's been a lot of liquidity in the system. Banks are able, although maybe not as much as people would want or expect, are definitely there with capital. I think 50% of the financing in general have been refinancings. So there's been a lot of money available for property owners to hold on and keep the pricing at higher levels, and they haven't been really forced to sort of sell. And because of I think kind of this goes with the low transaction volume, is the prices have been sticky. But, you know, as mentioned a couple of minutes ago, I think because there's this, you know, buildup of properties that are going to be, you know, needing to be dealt with, we do expect, you know, pricing to come down. Like I said earlier, we have a lot of our clients looking to buy properties, but they're not really quite ready to buy it at the current prices. You know, if they see a deal, or if there's even somewhat of a price break, they're willing to pay a reasonable amount if they see some light at the end of this pandemic. But they're not sort of chasing deals, and sellers, when they're ready to sell at a reasonable price, there will be, I think, a lot of buyers out there. You know, in terms of, just stop the share. You know, in terms of the future, I think, you know, we expect, you know, to be extremely busy. There will be a lot of things to work out and things to be sold, but it really, I think it's going to be a bit of a tale of two cities. You know, the way we've seen, like on the stock market, the you know, tech indices are going crazy, whereas, you know, a lot of the value investors are still sitting on huge losses. I think, you know, the opportunities there will be opportunities. But the question is, you know, which sectors, what's going to happen as we move back, you know, to a new normal. If you're able to pick the right places, there's going to be some real success stories. But, you know, not everywhere. It's not going to be uniform across property types, across regions. It's, you know, I think it's going to be, you know, very specific. You know, just to show you, there's so many mixed signals in the marketplace. I was reading that Facebook recently, you know, on the one hand, everybody knows Facebook, back in the spring said, oh, from now on, all employees can work at home permanently, which was quite an extreme, you know, death toll for the, you know, the office market. You know, on the other hand, this summer they signed 73,000 square feet of, 730,000 square feet of office space in Manhattan, of all places. So, you know, you sort of see a lot out there. You know, retail, people think retail is dead. On the other hand, you know, a lot of smart money, Brookfield and others are now moving into the retail area, I mean, on the business side. So, you know, I think there's a chance that some of that will be kind of a reinvented retail. You know, retail is probably not dead either. So I think in terms of opportunities, I think, you know, I would end by saying, you know, you got to be patient. I think this is, you know, someone said earlier, we're probably in, you know, the first or second inning of this story here. And, you know, you got to be patient and sort of pick, you know, there's going to be a big divergence between the winners and the losers. And, you know, keep that in mind as you're looking, you know, and, you know, be patient. There will be opportunities as this thing works its way through. You know, with that, you know, we look forward to working with other people on the panel and out in the audience in the near future. So thank you.
Thank you, Joshua. Thank you. Bill, you're next.
Hey, thanks, Ron, and good morning, everyone. Thanks to my fellow panelists for the words so far, and I'm sure what we're going to learn. I'm Bill Looney. I work at DebtX. We are a loan sale company at our heart. I mean, we're not a smaller piece of a bigger company. Along those lines, we do a lot of analytics. We do a lot of valuation work for institutional clients, GSEs, agencies. So we have a really good pulse of what's going on the origination side, but mostly in the secondary market side. We also handle the fintech business. So there are lots of banks, especially large banks in the syndicated space, that use our platform to do their trading, to do their agency work, to do their loan syndications. And so we've got a good handle there. And of course, I work in the loan sale group, and we've been really busy a little bit. So I know Steve and Jim, we were in the same capital market space. We also spend maybe more of our time in the bank space. We've got hundreds of banks selling clients. And I'll try and give you a little bit of a perspective what we're hearing from our banks. I think the first phase of COVID for banks, sort of March to June 30th or so, we would have caused the crisis mode, right? They processed 5 million PPP loans. They funded, $500 billion or so, all sorts of automatic deferrals, everybody trying to get just work from home squared away. I think since June 30th, we've entered the what we call the credit triage phase. Banks are really active right now in going through their portfolios, in staffing up, and in taking loan losses. You saw at the end of the second quarter, JPM, Wells each, I think, took $1 billion in loss provisions. I think Citi took $750 million. So banks are really busy preparing for what Jim described as what's going to be the next phase, right? The first round of deferrals, easy, everybody gets it. Second round of deferrals, okay, we're going to ask a few questions. We may require some things from you. And then, eventually, it seems to be starting, we think, in Q4 and certainly early in 2021, what we would call the credit reckoning. The regulators have been super hands-off. The banks have been, super accommodating and empathetic to their borrowers. But at the end of the day, it's a numbers game, right? And if a borrower can't make their payments, you got to do something. And the banks we talk to, at least, are putting a lot more staff. As Jim mentioned, I'm sure his FTE count is way up in special servicing. Banks are sifting through the customers and asking themselves, what are we going to do with these borrowers? Are these people who we think can make it and we want to put the time and the money into helping them? Or are these folks that, we may just have to part ways? And those decisions are being made now. So we expect 2021 in terms of dispositions to be very active. We did 2.5 times, I think, volume in Q3 than we did in Q1, which shows sort of what's going on in that. And I think unfortunately that if the extensions that have been granted were called TDRs instead of COVID-related extensions, you'd see the NPAs, you'd see the subperforming and non-performing assets in banks skyrocket. And like I say, it is a numbers game at the end of the day. And there are just some borrowers who don't have the capital and don't have the liquidity to survive without banks. There are a lot of properties, I'm sure the property guys here can tell you that unlike in 2008 or 2010, it's not a question of dividing up meager NOI. There are a lot of borrowers that just can't make their OPEX expenses. And so in many cases, borrowers are acting as stewards for the lender's collateral. So what have we seen so far in terms of secondary market? Like I said, we've been super busy. The good news is the supply, I guess, I don't know if it's good news or bad news. The supply imbalance remains. There are more buyers for distressed loans than there are sellers. And so the prices have held up. The market is much, much choppier. We have not seen a lot of COVID price fade. We've seen some deals trading right where they would have traded pre-COVID. And we've seen some that have a 10% discount. The price discounts have not been as great. But if you're a seller, in 2019, you could probably have picked up the phone and called 3 or 5 buyers that you knew, make a quick market, get a pretty tight range of prices, hit the bid you wanted and moved on. I think those days are over. What we're finding is we have to cast a very wide net, bring in as many buyers as we can, because some buyers are out, some buyers are in, some buyers are new. Jim mentioned his experience on Real Insight in terms of buyer registration. We've experienced the same thing. Deals that we had, we're getting 200 CAs plus for deals that we've been offering. So the market is still there. The buyers are still there, but it's a choppy market. You end up at the same place. but it's not for the faint of heart. It's been tough. Who knows what the future is going to hold in terms of hotels? We've been lucky. We've cleared a couple $100 million in hotels so far. We've got some really good data on it. Again, that is, that's obviously been hard hit. So we've seen a bunch of hotels. We've seen healthcare. I think healthcare, that was troubled. Healthcare and retail were troubled going in. Hotels were completely caused, I think, by COVID. And so we think that it's important to get out there. It's important to look at your portfolio, make active management decisions about what you want, and cast as broad a net as you can in terms of hitting the market. So,
Thank you, Bill. Michael?
Thank you, Ron. Good morning, everybody. Michael Bell here, president of Bell Aldo. We are environmental risk managers. We are not a phase one shop. Our work often starts after there's some documentation. But I just want to start by thanking my fellow panelists. These comments really set the stage for the movement of distressed debt. And I'm going to focus on just one part of it, which is specifically environmental issues that can cause contamination on commercial real estate. So oil and hazardous materials, underground storage tanks, manufacturing, automotive care, and dry cleaning. And really the reason for bringing that up is that there's a federal law from 1980 called CERCLA that commits property owners to environmental liabilities on real estate. And this is important to keep in mind when taking ownership of real estate. So if that is part of the end product, either through foreclosure or loan purchase, then it's important to keep in mind, because there are obligations to new owners, not only for current issues on properties, but also for past issues, which means that a new buyer may ultimately own the past owner's carelessness. So there may be contamination on the property that becomes the obligation of the new owner. And one thing to keep in mind, I think this is always important, is that the cost of remediation can outstrip one's investment. Regulators do not care what you paid for an asset. They just want to make sure that the work gets done, so there can be additional costs. Now, there are certain protection for lenders during foreclosure. They can park the asset. There's some kind of safe harbors. But the reality is that the next person in the chain doesn't have those protections. The new buyers don't have those. It's worth noting that there are certain states that offer liability protections to new owners, but there's still the need to get to that point to understand what's happening on the property. Consequently, it is incredibly important to understand environmental risks before taking title. And what we do at Bell Aldo is to understand risk by doing due diligence and then helping to position the asset with that risk in mind. Rather than it being a barrier, we help to make sure that it's clear what the liability is and how to best address it. One of the big things is starting with just converting the scientific jargon into business friendly and usable language. So get away from the science and get towards the business. So just a couple of things to really highlight in terms of when it's a good time to look at different due diligence. For banks, it really starts with the watch list. That is the document that houses those properties that are of concern. And it's a good time to start the due diligence process. It's possible to do it high touch, just get an understanding of the known and potential risks. And it helps in terms of knowing where you might want to go with the asset. Big question, to forbear or to foreclose? And this is another good time, if you've already gotten to this part of the process, to understand what's happening on the environmental side, because if there is something there that would cost more than the investment, it might be a good time to stop those proceedings and either to sell the asset or discharge or do something else. Foreclosure is a little bit different. This is the point at which we're actually considering crossing that line from being a lender to an owner. And even though there are some protections, it's a good idea to understand what the liability is. So it's a good time to engage an environmental professional, maybe do a phase one, get an idea of what's happening. The next step is note sales. So if you're putting together a portfolio of note sales, then one of the things that you can do is to look at the environmental risk in preparation of bids. The idea being that if somebody comes along and is giving a arbitrary haircut for an environmental problem, if you've already done some diligence and understand what the range of those costs are, those negotiations go back in your favor, and it may be beneficial. Bill just mentioned something, which is that banks at times ask their customers to leave. And when that happens, we offer a product that we call the environmental primer. So rather than sending your borrower down the road unprepared, your desire is to get your money back, we can put together a primer, an overview of the environmental issue on a property. It gives a high-level overview. It gives cost to cure, time to cure, some scenarios as to how somebody could address those issues, and allows the takeout lender to feel more comfortable to box those risks in when they're looking to have their new borrower. From the equity side, purchasing debt, looking at those assets either as individual assets or as a portfolio is particularly important, especially if you envision taking ownership of the real estate somewhere in the transaction. We have all different kinds of tools for looking at portfolios. Sometimes it's as simple as giving a thumbs up or a thumbs down, or some other details like a stoplight in terms of degree of risk and what you might find. Foreclosure is always an issue, same thing. You want to get an idea early in the process to see what the liabilities are. And with equity funds, if you're going to be involved in development on the asset, if you take ownership, it's a good idea in advance to get that worked out. Find out whether or not during development, if there's going to be need for soil management plans or any kind of regulatory documentation, have that laid out, and it just makes the whole process that much easier, and you can keep track of your costs along the way. My last comment for now would be that people ask me whether there's any horror stories in this business, or is that something of the past? And although the circular regulation has been around for 40 years, and I've been in the business for 30 of them, sadly, there still are horror stories. There are new buyers or new property owners that are getting caught with liabilities that are costing them well beyond their investments. And really the best thing to do is complete due diligence, determine the risk, better be more able to negotiate, and really to avoid the disasters. And I too would look forward to future conversation. Thanks, Ron.
Okay, thank you, panelists. We do have a couple of questions from the audience, and let me just tell you what they are. No specific names associated with the questions. First question is, which region in the United States, in your opinion, will fall, quote unquote, first? Steve, you wanted to give that a shot since you're a nationwide company?
I think it's, depending on what state, judicial, non-judicial state will determine, how this process works. But as far as an area of where it's going to deteriorate the most, I think it's everywhere. I mean, I don't think it's determined what part of the country is going to fall as far as, or how far it's going to fall as far as value deterioration. So that's yet to be determined. We know one thing: hotels are plummeting. We thought retail was going to drop further than hotels, but that has not yet to be determined. So, there's not really one area of the country that I feel is going to fall further than others yet. So it's maybe a non-answer, but that's what I feel at this point. That's what we're seeing.
Yeah, I think, this is Josh. I was going to note that while I would probably agree, I don't think necessarily any region you could say is going to be hit. I do think, to state the obvious, I think cities are going to be hit much more than suburban. Even if you look at like office suburban office is not going to be hit as bad as, mid downtown office space. And I think you're going to have cities, there's a lot more deterioration in the cities. Taxes are going up. People are moving out of the condensed spaces. So I think that you're going to see that kind of trend happening more so than regional.
Okay, yes, James.
I was going to add too, the areas that we're concerned about right now, Hawaii, because it's a fly-to location, and without the tourism drive, it's going to be a problem. Orlando and Vegas are right up there as well. You saw today, Wynn announced that they're not going to open their properties during the week. So that's just showing where the trend is going there. And then I think we need to discuss Oregon with the restrictions on what you can do with the assets in that state. I don't know how lenders can lend going forward in that state.
Okay, second question. Participant wants to know, is this a good time to invest in distressed oil and gas real estate? Any thoughts on that?
It's all a matter of valuation. I mean, depending on where it is. I mean, Houston's getting hit pretty hard. The values were really high at one time. It depends what the tenancy is in the asset that you're buying. So, and its basis. So I think, I think that's, you got to see what each asset takes and what each asset looks like.
In our portfolio, the initial CMBS troubles for 2.0 CMBS, which is stuff originated, 2012 and on, has been in that oil and gas area, and those properties still have not recovered in terms of value. So I think I would probably be cautious investing in those markets.
We did a lot of oil and gas really pre-COVID. It was like hotels sort of post-COVID, oil and gas pre-COVID. Obviously, the oil markets were messed up. There was a time that crude was trading for less than zero because it cost so much to store it. That's a crazy market. I don't think the long-term trend is your friend in that market. Everything from the producers, the oil field service companies, we saw a lot of work boats. They were all trading pretty close to scrap value. Now, maybe that's for the right time to get in, right? I mean, that could be. But what you see in that business, generally speaking, we don't do the big name credits. We tend to do the tier 2 suppliers, and they're getting crushed. And it was awfully hard to see a path forward from there. And then, up in the Bakken Shield and some of shale country, the hotels in those spaces obviously were aligned. So, but like I say, my pessimism, if my personal experience in real estate is any guide, you're probably, now's the time to get in.
Our next question is directed to James. Participant wants to know, does C&W sell directly to buyers?
We do. I mean, people can go out there and, there's a lot of sites out there that can tell you what's in our portfolio, and they may reach out and make an unsolicited offer. We evaluate that offer and determine, through a number of different discussions, whether it's, acceptable. If not, we may end up just marketing the asset as well. Feel free to reach out.
I want to get Matthew in here with one of my questions.
So reach out to me first, and I'll call Jim.
Okay, fair enough.
Steve, does that seem prudent to you?
No, I think they should reach out to Newmark. Yeah, I could say DebtX too. Then we'll call Jim, and we'll make it happen for you.
Matthew, my question for you is, what are the major or primary tax and regulatory issues that a seller or a buyer should be aware of if they're entertaining a distressed purchase or sale?
So it's a good question. In terms of tax issue, in terms of let's start with regulatory first. At the end of the day, due diligence when you're acquiring a loan is of the utmost importance. And one of the major factors in terms of geography and locale in which you're going to be purchasing alone is going to be what sort of regulatory schemes have come in play as a result of COVID. And like I said before too, as well, what sort of rent control regulations or otherwise are coming into play there. In terms of tax issues, again, as a real estate attorney, I would say, it's always important to evaluate, sort of exit strategies and how you ultimately would, intend on acquiring an asset. So taking a look at various issues like, is there a tax on, if you ever got to a sheriff's sale, is there a tax on, the commission, and is there a tax or property tax, what is your realty transfer fee in connection with it? A number of states have controlling interest transfer taxes as well. So if you are going to be purchasing mezz debt and you are looking to go via assignment in lieu or otherwise, as you're underwriting the asset, it is important to go and analyze whether or not there is a controlling interest transfer tax in that particular state, and how is that calculated. PA calculates it very differently than New Jersey does, and Oklahoma does it differently than all those other states as well. So you have to go and look at that on an individual, on an asset by asset basis. Connecticut has a controlling interest transfer tax as well that could be implicated on deed in lieu transfers. So you have to go and evaluate the tax consequences on your exit strategy in connection with buying any distressed debt at this point in time. And it really is a jurisdiction by jurisdiction issue. And as you're doing your due diligence, that should be factored into, your price and, again, what you're budgeting for ultimate strategy in connection with any of these assets.
All right, my next question is for Joshua and Steve. If we are only in the beginning of a long-term situation with these depressed assets, how does a seller today properly value his or her asset if they're looking to dispose of it?
You want to answer that on this debt side? I'll answer it on the real asset side, Steve, or?
I mean, listen, valuation is key. How do you determine what kind of assumptions you make depending on what product type? Luckily we are a national firm, so we have a lot of boots on the ground to figure out how the market is turning and where. It all does start with the collateral and what the collateral is going to turn, what value, the collateral valuation, and what new assumptions you can put in, vacancy rates, rent increases, expense increases. So, we are in that middle of the time right now. It's like we bat our heads against the wall of what kind of returns are necessary for the market, what kind of market lease assumptions we're using, price per square foot, internal rate of returns, yields, all those factors cause new valuation. And it is tricky right now. And, we're not shooting in the dark, but we are discounting accordingly. But to counter that, like everybody has said, you look at the investor market, it's so thriving right now that, you hedge to that way as well. What we were telling every potential seller, bank, or institution we're dealing with, sooner the better, because we don't know really how the deterioration is going to continue. So if you are teetering on deciding to sell a note or an asset or what have you, be the first ones, be the pioneers, because I think you'll get better value out of it at this point.
Yeah, I would say on the asset side, at this point, valuation has two components. It has, what's the cash flow basically, and what's the cap rate you're going to apply to that. So I think in terms of cap rates, that's kind of an interesting question. I think no one really knows at this point, what to look for. I think people are still hoping and trying to get the same cap rates that they had been, traditionally, depending on the asset type. But where I think you're starting to see the, the decrease in valuation is because people are looking at cash flows in a different way. So they'll look at very much on, to date at least, they'll look at individual assets. We've seen properties when we're talking to sellers, they're looking to sell at, whatever number, we really have to reevaluate the projections. That's sort of the key. If you're dealing with a retail center, now you have to expect, that much more vacancy, or that, what are going to be the renegotiated rents if they're going to be renegotiated. So you kind of have that aspect in terms of evaluating the cash flows. And, those have gone down, a lot and a little. We saw pricing overall to date has only been down, 1.5% or 2%. I'm sure appraised numbers would show them down much more significantly because they're a little more, hopefully, not traded value, but the actual expected value. So, I think so far we've seen some deterioration based upon revised projections and keeping cap rates the same. I think that most of our sellers that we've been talking to, there's a feeling, and I think to reiterate, people are looking to, if they have an opportunity to sell it to a buyer who's interested, they're really motivated to make a deal because they're very concerned about where valuations are going. No one, I don't think, to answer it, no one really knows at this point. We're still early in the cycle. Depends on what the servicers are going to do with their, clients and how that's going to, or borrowers and how that's going to weave its way through. But, there is a feeling like if we can make a deal now at a halfway decent price, let's sell the asset because there are buyers out there.
Next question, Michael, let me get you in here. From an environmental point of view, have you come across a situation where your work has been a deciding factor in terms of having a deal actually done or a deal fall apart?
Every day. Sure. Yeah, we are definitely.
Like environmentalists.
Yeah. Geologist with an MBA, a little different.
Okay, sorry.
But yeah, it absolutely. And that's the reason that people hire us, is because they don't want to be the one stuck with that liability that costs them more than their investment. Those deals we call run for the hills. There's certain deals that have environmental liabilities on them. And unless somebody plans to have a great value add, go from industrial to residential along the waterfront, where they can afford to deal with that kind of environmental issue, it's just not worth the brain damage to go down that road. And then conversely, there's time where the market thinks that there's something going on, and due to our research, we can figure out that what we call a manageable risk. It is possible to figure out the liability, and either there's equity in the deal to address it, or there's some other kind of way to do it. But that's why people engage us. They want to understand where the liability is and whether or not they should go or not go.
Okay, we got.
I would actually add to, people that do what Michael does, they really add tremendous value to most transactions. We found that we often recommend to sellers who have an environmental issue with their property to sort of proactively engage, someone like Michael to come in, evaluate the property, and provide that to the buyers. And that really enhances bidding and gets people, they could get more comfortable. Even if there are risks, at least to sort of know what those risks are, is extremely helpful in a transaction. So I would definitely agree.
All right, two more questions from the audience before we break for the networking part of our program. The first one is, when is it appropriate to buy the property versus buying just the debt?
Well, I think, buying the property, or buying an REO, real estate owned, you do not have to go through the foreclosure process. And there's some jurisdictions, where it's quite difficult. Texas, Georgia, very easy to get to the asset, where New York, Pennsylvania, and Connecticut are very, very challenging. Jersey is another one. And, there's a receiver typically put in place and you lose total control. So I think that the opportunity is probably better to buy an REO. Note-wise, it may give you an opportunity, if you can buy it at a discount, to restructure the debt and make it work for both parties. So it depends on the opportunity.
Yeah, we deal with this problem all the time, and I say it's a problem because we we'll find very often we'll be advising a seller on the sale of property because we, focus more on the real asset. And then next thing we know, the sellers we're talking about selling the property to are doing end runs, trying to approach the bank, thinking they could get a discount on the loan and end up buying the property, more cheaply. So I think it's very, situation specific. A lot of banks, if they're willing to play ball and give a big write-off, that's an option for people. And that's often what they like to do, really regardless of the jurisdiction. But, often banks want to get paid, 100%. They know they have good collateral.
Right.
So it really depends on, where the seller's at. Is the seller looking to make money? And what's the situation? So I think it's very situation specific.
But there are some risks buying the note. I mean, there's potential bankruptcy risk, environmental risk. You're taking on a lot of the burden of, taxes and there's a reason why the asset's being sold, right? And you'll uncover a lot through the disposition process.
But you do have different ways of figuring out a loan. It doesn't just have to be a loan to own. It could be a modification. It could be, a payoff or such. So there's a lot of different areas that a loan can go. And, obviously it depends on discount as well. I mean, the investor market is so feverish on buying loans. It's crazy. Bill can attest to this. And it's all your investment thesis. Where are you looking to place your money? In real assets and or loans? But there's risks on buying assets and there's risks on buying loans. It's a matter of how you invest, how you underwrite, and how you figure it all out.
Yeah, I agree, Steve. I think that the options are a fair bit broader on the note side. But let me flip the question around, Ron, if you don't mind. And the question is, should you sell the note or should you wait and sell the REO, right? And we're seeing in banks, they do not have a big appetite for being long REO. That is a lesson that's been learned time and time again, right? So note sales offer a pretty quick, extremely efficient method of getting it. And if you own REO or if you buy REO, your options to deal with it are very limited, right? You got to find an end user, you got to take the time and make the investments and carry the cost to get it to an ultimate cash flow some months or years in the future. As Steve mentioned, with a note, if you're selling a note, you don't have to find the end buyer. You're going to get 100 folks that are going to want to bid on that thing. And the bid ranges are going to be pretty broad. But you pick the high bid and you're going to extract almost all the value, if not more. And you're going to do it today, not 2.5 or 3 years from now. So, we're seeing, like I say, the appetite for REO. It may be different in banks than it is in other areas, but there is not a big appetite for REO. It is very expensive, very time consuming. And of course, the capital charges against banks and against most lenders are very high. So,
and to Bill's point again, the loan sale business, I've been doing it a long time, has become so sophisticated, and the investor market's become so sophisticated that it's a real true business, real true service line. But I got a question for Jim. I think it would be great for Jim to explain how this cycle CMBS is going to work based on the previous cycle when the servicers had a right to hold on and work out the assets longer. And I know there's restrictions or differential in the service agreements of how you guys act. I think that would be a good question. Maybe you can answer that today, because CMBS 1.0 is different than CMBS 2.0.
Sure. So crisis, kind of two questions there. How is this crisis different from other, this happened all at once versus, 2009, 10, 11, the assets, declined over a period of time. And I think that first crisis, it was a valuation crisis. And as I kind of mentioned earlier today, we look at these initial appraisals that are coming in during COVID, we're seeing about a 25% decline on average, which means that you're still value good, right? Because a loan is made at typically 75% loan to value. If you have a 20% decline, you should still be value good. Now, it varies depending on the asset classes within even like retail, where malls are taking a tremendous hit compared to maybe something that has an anchor to it. Movie theater, very difficult to value now, and some other things. So the second question is the difference between legacy and what we call 2.0 CMBS. In legacy, a bondholder only realized a loss when there was a disposition event, so realized loss. In the 2.0 world, it ties to an unrealized loss. So a deal comes into special servicing, let's just say the debt's, 20 million and the appraisal comes in at 10 million. That $10 million difference, delta, would be counted as a loss. And that what happened, as most know, is you eat into the bond cushion. There could be a change in control in that class. And we've actually seen examples where we've had losses, and based on the appraisals, we ended up disposing the assets, and we outperformed where the appraisals were, and it actually had shifted to a class above, and then it shifted back down. So there'll be a number of movements in the controlling classes, in our opinion, and we are starting to see some of that now with the appraisals coming in through COVID.
Okay, we need to start to prepare to break to the networking portion of our program. So let me just finish up with some last comments. First, I want to thank the audience for attending our webinar this morning. I also want to thank all our sponsors. Their logos are now on the screen. In addition, I would like to ask the audience members if they have any feedback, positive or negative. Love to hear about it. My email is on the last page of the slide deck, and everyone else's email, all our panelists' email, are on the last page as you see on the screen. Please provide any information you have, any suggested topics that you would like us to put together in a program in the future. Please let me know that as well. In addition, if any of our listening audience is interested in becoming a sponsor and a panelist to a future program, please let me know as well. Want to thank again our sponsors as well as our production people at Financial Poise and its subsidiary. And now we will break for the networking portion. Everyone who's still listening in has been sent a link to link in to the networking portion. And thank you again, everyone, for attending our program. And we look forward to seeing you and talking to you again. Thank you very much.